Good afternoon. Welcome to another episode of the Multifamily Minute with Old Capital. James, I've been seeing a lot of investment opportunities lately and they kind of all look the same. How do you tell which ones are good and which ones aren't?
So every general partner is going to say they're conservative, right?
For sure.
The underwriting was very conservative. And then pretty much every investment package right now says, 8% average cash on cash,
15% IRR.
15% IRR plus, right? And so what you have to do as a limited partner is really dig into the assumptions of how they got to those returns, right? Because pretty much, both of us are really good at Excel, and you can change one number, you can change the rent growth number, you can change your pro forma rents, you can, reduce your expenses, and you can get to that IRR and that cash on cash. But you have to look at what sort of the building blocks, what's the foundation of getting there, right? So are you having to raise rents 10%, 20%, 30%? And then how much CapEx are you having to do? What's your assumptions for expenses? And then what's your residual cap rate, right? So if your cap rate right now is 4% and your residual is 3.5%, then you're going the wrong way, right? So you usually want a residual that's maybe 25 basis points, 50 basis points higher than what your in place is. So each one of these line items, whether it's revenue, expenses, cap rate, all those things are going to factor into how likely that those returns are going to be hit. So when I'm looking at a package, I'm usually looking for conservative underwriting that's hitting those returns, and then I want to see outperformance in those metrics.
Can you elaborate a little bit on residual? What do you mean by residual?
Yeah, residual is really just, all right, so I'm buying the property, let's say we're buying this property today, and it's a 4% cap.
Yep.
When I go to sell the property, you're probably going to need at least probably 25 to 50 basis points. And then when you go to sell the property, you're going to take your NOI and then divide it by that residual cap to get the value that you're going to sell the property for.
Okay.
And so what's happened in DFW is that the cap rates have come down so much that, when I first started, a Class C property was like a 7 or 8% cap rate.
Oh, wow. That's
So if you buy a property at 7 and you sell it at a 5, you made a ton of money, even if the NOI stayed the same. And so that's what you want to build in a little conservative. If interest rates come up, cap rates move up a little bit, there may be not as much demand for some reason, then you want to build that into your assumptions. So I'd rather see, let's say those 15% IRR, 8% cash on cash, but then I'm using, let's say, a 4.5% cap rate versus a 3.5 cap rate. So if I'm having to use a 3.5 cap rate to get to that IRR, that's a little bit more aggressive on the underwriting.
Awesome.